All right, I think we might get started. Um, with so many meetings online nowadays, I always say on time is the new late. So let's get going. Well, good afternoon and welcome to this SW Financial Reporting webinar series, wherever you might be joining us from. I'm Renee Muller, a partner with SW, and I will be moderating today's session. It's great to have so many of you on the line today. Firstly, I acknowledge the traditional custodians throughout Australia and their connections to land, sea and community, and we pay our respect to their elders past, present and emerging. Before we start, a little bit of housekeeping. We recommend that you click on the Enter Full Screen button at the top right-hand corner to achieve the best webinar experience. If you click the Q&A button at the bottom of your screen, a window will pop up that will allow you to send us questions as we go. We will monitor these and answer any that we can during the presentations. Some we will save for the Q&A at the end of the session, but for more bespoke questions, we may need to connect with you after the session today. We will also circulate the slides after the webinar as usual. So I'm joined today by my esteemed colleagues, Tom Alaki and Jimmy Chow, who are regulars on this webinar series. So you should recognize them. Hi, Jimmy. Hi, Tom. Our agenda today, we're going to be talking about accounting standard changes. I'm going to run you through those. And then Jimmy's going to give you some update on some IFRIC findings recently. I'm going to give you a bit of an update on what's happening with ASIC. And Jimmy's just going to touch on a couple of minor other regulatory changes. And then Tom is going to wow you with his sustainability update, because that is a bit of a hot topic at the moment. So Tom will tell you what's happening at the moment. Quite a lot happening in that space. Right, without further ado, I might kick you off with what's happening with accounting standards at the moment. So there are a few standards that are effective for the first time for 30 June 2024. So these will have been effective for the first time at 31 December 2023. But if you're a June reporter, this June for the first time. The main one that I want to run through today is just a bit of an update on the disclosure of accounting policies and definition of accounting estimates one. And similarly or relatedly, the Tier 2 and other Australian accounting standards update. Now, this is actually going to impact most people, most accountants, most financial statement preparers. There's a couple of other major things that's also new for the first time. The one is AASB 17 on insurance contracts. I'm not going to run you through that in any great depth because not too many of our clients will be impacted. And the other ones have been there in the background for quite a while. We've done updates on those before. So I'm just going to focus on the one that I think will be the most important to our clients. Now, this change to AASB 101 is changing the concept of significant accounting policies to material accounting policies. Now, the purpose of this change is to make sure that those accounting policies that you have in your financial statements is tailored rather than boilerplate. And a lot of companies have been copying and pasting or just using some template notes rather than saying, what are my material accounting policies that users would want to know? So what is the definition of materiality when it comes to an accounting policy? It doesn't necessarily relate to the number that you've got in the accounts, but an accounting policy is likely to be material if a change in policy, or where you have a choice in accounting policy, or where you have related significant judgments and estimates, or where it's complex, then it's more likely to be material. So we're only talking about the accounting policy with this change, not the actual disclosures. So if I give you an example of how this might happen, so many companies like to copy and paste the full accounting policy note on financial instruments. You might only have debtors and cash in your financial statements, but a lot of companies still, even though they only have debtors and cash, might still copy and paste the full financial instruments accounting policy note. After adopting this change, you should only consider, should I or shouldn't I have an accounting policy on debtors, right? So because cash is cash. Now, if your debtors balance is material, that still doesn't mean your accounting policy is material, because accounting for debtors is relatively straightforward. In particular, if you have a revenue accounting policy already, it's not necessarily complex, but some companies might have complex debtors or complex provisions for credit provisions around those debtors. That might be complex and that might be material. And in that case, you might need a tailored accounting policy for your specific debtors rather than the 3-page note that you might copy from elsewhere. If you have any questions on that, give me a call and I'd love to discuss it further if you have a complex situation. But I think it might delete some of those clutter out of people's accounts. So I think this is a positive change. This is also applicable for Tier 2 simplified disclosures accounts. Now, when we're looking at future periods, some future changes that's coming up, there's a few things that are changing. Most of them that's coming through are kind of annual improvements, maybe some wording changes, some consistency updates. But there is one that I do just want to remind you of. We've spoken about this before, but I'll just remind you of the classification of liabilities as current or non-current, because that might impact a lot of our clients. So the change is, the standard used to say for a liability to be non-current, the right to defer settlement must be unconditional. That wording is now changing to have substance. So that's a bit of a change that lowers the bar for a liability to be classified as non-current. So what we're telling our clients is just go revisit your classification. Just have a look at your agreements, have a look at your covenants, have a look at your year-on-year rollover arrangements, and just check whether your classification is still appropriate with reference to this new wording in the standard. Now, I also want to talk a little bit about exposure drafts, because there's a couple of exposure drafts out there that I think could significantly impact our clients. Now, an exposure draft is something that the AASB puts out there for preparers and users of financial statements to comment on. So it's not actually part of the standard yet. It's a draft, and then the AASB collects comments, gets people's views on it before it becomes part of the standards. So this first one that I want to talk about today is still open for comment. So if this is going to impact you and you feel like you have a strong view on it, you still have time to make some comments on it. So this is called ED 329, and it's on business combinations, disclosures, goodwill, and impairment. Now, I think this is going to impact a lot of our clients because a lot of our clients have goodwill balances. And if you have a goodwill balance, this is likely to impact you. And a lot of our clients also have transactions in process, business combinations that they're planning, transactions they're thinking of. They might have an acquisition strategy. If you fall in that bucket, best to talk to your SW representative sooner rather than later, or talk to myself or Jimmy about it. You are likely to be impacted by this change if it comes through, if you have goodwill or business combinations. Now, what's behind this is users of accounts have fed back to the International Accounting Standards Board that they need better information on assessing the success of a business combination. The feedback that the International Accounting Standards Board has received has been that impairment to goodwill would typically happen a year, 2, 3 years after the business combination, even though to management it might have been clear that the business combination is not going as well as planned. The planned synergies might not have happened. The performance they forecasted hasn't quite materialized. But because the impairment assessment is based on forecast, which might be a bit optimistic, the impairment doesn't happen for a couple of years, 2, 3 years, until it becomes clear that it can't be pulled back, right? So users of the accounts have said they want to know sooner, how is this business combination performing? And is this goodwill likely to be impaired at some future stage? So what this ED 329 is proposing is additional disclosures around how a business combination is performing, how synergies are tracking compared to the expectations, and so on. So that's one key thing, is the disclosures around business combinations, performance, tracking, and so on. The other thing it's proposing is some changes to how value in use is being calculated in that impairment assessment. and how goodwill is being allocated to CGUs and the related disclosures around that. So there's a few different things in there. And it's going to be really interesting to see, A, whether this goes through and when, and B, how this impacts our clients who have business combinations and goodwill. There's also some other exposure drafts that are now closed for comment. The first two are mainly sort of clarifications of what's already in the standards around financial instruments, clarifying just the accounting treatment for new and innovative financial products, and using more modern language around electronic payment and so on. So it's kind of updating the existing treatment for just different terminology, consistency, just clarification of how, in a more modern context, some of those principles will apply. So I don't think the first two will radically change the world for anybody. But the third one, ED 298 on general presentation and disclosure, is really interesting. And I think this is going to impact a lot of our clients, in particular listed clients. And so what companies are feeding back is that increasingly common, Australian entities want to report non-IFRS performance measures, in particular, things like management performance, or they might call it a cash profit or underlying profit, because companies feel often that the current way they're presenting profit in the statement of financial performance doesn't reflect the story of the underlying conditions of the year, because there might be a unique set of circumstances that impacted them for a quarter during the year, or there might be an exceptional circumstance or something strange that happened during the year, and they feel their profit for the year doesn't necessarily show where the business is at. And so often what companies are doing at the moment, based on the current rules and standards, is they would put that non-IFRS profit measures in the director's report. And anything that you put in the director's report isn't necessarily audited. It might be reviewed for consistency, but it is unaudited. And so it doesn't necessarily have the same weight as it would have if it's on the face of the primary financial statements. So this ED 298, this is already passed in the international accounting standards. So this is the IFRS standards have already been updated for this. So this is the Australian version. It's most likely to follow suit. So I think this is quite an exciting change for us for financial statement preparers in Australia, because I think it just gives a little bit more power and opportunity to management to tell their story of their performance a little bit more in their own way. And so you're not going to be able to go crazy with non-IFRS information all over the accounts. It's going to be quite specific in terms of what you are allowed to do, but it creates an opportunity to have different subtotals and then expand in your notes on how that's put together, and just defining some more of the terms that you're using, like operating profit and so on. So in Australia, we also have a regulatory guide on disclosure of non-IFRS information, and that would also have to be updated to just allow for this change. And so the AASB has said that they're working with ASIC on making sure that we're consistently changing this to give companies an opportunity to report accordingly. Right, so that's it for me for now. Jimmy's going to give us an IFRIC update, and then I'll see you again in a minute.
Thank you, Renee. Before I tell you about what's happening now with IFRIC, I just want to spend a few minutes so briefly explain what is IFRIC and why it is important. So IFRIC stands for IFRS Interpretation Committee. So they are the people who read the IFRS and apply that in the real life situations. So by doing this, it will promote the consistency applications of the standard. So they do publish their workings. How do they reach certain conclusions? So why is it important? Why are we looking at it? Is firstly, the IFRIC decisions form part of the accounting standard. So when you are applying accounting standard, you do need to look into IFRIC, what they say about this particular standard. And different from a lot of the new accounting standard, for example, the one Renee has introduced previously, So for those new accounting standard, you typically given a few years of adoption times. You will give chances to restate your opening balance. That's quite a fair bit of leeway. But for whatever things IFRIC put out, because they are already part of the accounting standard, it's almost immediately effective. So a few years ago, we did get one of those blockbuster IFRIC decisions. Those are to do with whether or not you can capitalize the software costs. So a lot of our client was actually affected by the IFRIC decisions. So I have here listed a few of the IFRIC decisions that's put out in the last 12 to 18 months. If you are interested in any of the items, so I'm going to talk about two of these today. And if you are interested in any of the item, please come and talk to me and Renee. I'm more than happy to give you the details and help you to see how will that affect your company. So I'm going to talk about two IFRIC decisions, and both of them are to do with whether or not to recognize a liability, whether or not to recognize a provision. So I think it's actually a very good time to just give you a quick reminder, quick refresher on what is provision and when do you recognize a provision. So a provision is a liability that's of uncertain timing or nature. So you have a liability, but you don't know the exact timing when you're going to pay it, or you don't know how much. So to recognize a provision, you actually need to fulfill three criteria for you to be recognizing a liability. So the first one is an entity should has a present legal or constructive obligations as a result of a past event. So the past event is, for example, a law has been effective, or if you do something that suggests you're liable of something. So the present obligation is a very important word. So when we are looking at the IFRIC decision, we'll go through those in a little bit more details. So once you have a present obligation arising from past event, and the outflow of money need to be probable. So from the accounting sense, the probable means more than 50%. And then the amount, the dollar value need to be reliably estimated. So in most of the case, that's the situations. So let's look at the first IFRIC decision. So that's to do with a company putting out their commitment to net zero. So they're saying we are committed to reduce our emission by 60% in 2029. So if we are not doing that, what we are going to do is to acquire carbon credit from the open market and retire it. So to support the statement, they actually have published a very comprehensive transition plan, that include how do we update our manufacturing process, what are some of the changes we are going to do to our business. And in addition to that, in many public space, they actually say, hey, look at the statement that we put out. This is what we're going to do. So the questions to the IFRIC committee is, does putting out this public statement, by doing so, does the company need to recognize the provisions when they are making the statement? So let me give you the answer first. No, you don't actually book in a provision when you make the public statement. So the reason is, firstly, you need to assess whether this public statement tick off the constructive obligations. So in doing so, it does require judgment. So you need to look into the language, the detail of your plan to make assessment. So if you conclude that the statement that you put out does not give rise to a constructive obligation, then you don't need to worry about it. You don't need to book in a provisions. But continue to that, the IFRICs actually say, even you have a constructive obligation, even your plan is sufficiently detailed enough, you still don't book in the provisions. The reason is by putting out the statement, you haven't created a present obligations. Just think about it, similar to a new law that being effective, right? You not necessarily automatically need to pay things. So your past event here is actually after you emit the green carbon gases, when you commit to offset in the future, say in 2029, at that point of time you emitted the gases that you promised to offset. At that point of time, you're booking the provisions. So I just want to give company a reminder here. Even you don't booking the provisions, there is still quite a lot of accounting and reporting consequence that they need to go through. So one very important example is impairment. If you are putting out the statement and if you are committed to update your manufacturing process, the useful lives of your asset, do they need to be reassessed? Another complicated area is accounting for carbon credit. So we don't have accounting standard on the carbon credit. So how do you account for it? That's depending on the relative scheme and what do you use the carbon credit for. So we have seen quite a few of our clients working with this particular area. And again, the matrix and targets is going to be a key focus of the sustainability reporting standard that Tom is going to cover in a little bit more details. And also, quite interestingly, there is actually an active work plan in IFRS, IASB to change the provision standard. So there is a project, and we expect to see examples on climate-related commitment. So watch the space. The accounting outcome for now may not be exactly the same in the near future. So now let's shift gear a little bit. Let's look at another examples. It is also to do with reducing of the carbon emissions. So a government here has put out a measurement in order to reduce the carbon emissions. So a company is incentivized to sell more low emission vehicle. So if they do that, they earn some credit. But if they're selling more of the traditional vehicle, they will be deducting the credit. So for a company who has a deficit of the credit, they are required to eliminate those credit by either acquiring carbon credit from another companies, or they have to generate positive credit in the future years. So the question is, at the end of the year, if they are in the deficit positions, do they need to recognize a provision? So the answer is yes. So if you are if you are having a deficit of your credit, if you are not meeting the government target, you are required to book in a provisions. So firstly, there is economic outflow. You're either buying the carbon credit or you have to generate yourself. And the trigger point is at the point that you're producing or importing the vehicles that's exceeding the government credit. So this can happen any time of the year. It doesn't necessarily to be at the end of the year. The reason we are talking about this particular fact pattern example is when in the future in Australia, when we introduce a EV policies, and the company will need to look into the detail to see at what point of time, how do they recognize a provisions. All right, now I would like to hand over to Renee to give you a update on ASIC.
Great, thanks, Jimmy. It's fascinating to see how many IFRIC findings there are at the moment around sustainability reporting. Which also reflects how different jurisdictions are facing different issues because different governments are making different laws and the accounting standards don't necessarily address those. And so I'm really enjoying following the IFRIC updates as well as they're scrambling to find some solutions to some of these financial reporting issues. Now, I'm going to tell you a little bit about what ASIC's doing at the moment. So ASIC has released their most recent focus areas. And look, the actual focus areas for financial reporting haven't changed that much. For the most recent release, it's still asset values, provisions, subsequent events, disclosures, and the new insurance standard. That's the key focus areas for ASIC in terms of their surveillance programs. These haven't changed, but these are kind of the areas that you would need to be mindful of because that's the areas where a lot of judgments can come in. What has changed substantially is the background to which these areas are being applied. So for the last few years during COVID and post-COVID, ASIC has accompanied these key financial reporting areas with explanatory information saying you've got to consider these in the context of macroeconomic conditions. So you've got to consider your asset values and your provisions and so on in the context of, first of all, COVID, and second of all, post-COVID, some of the issues that there were maybe around interest rates, inflation, some supply side issues, restoring, the normal way of business, those kind of issues. That was the context in which ASIC advised companies to look at those key judgment areas. Now that's been completely changed by ASIC. They've taken all of that out. There's no reference to macroeconomic conditions anymore in their guidance to companies. They've now said you've got to look at those key areas, but in the context of your financial reporting process. So this is becoming the key focus for ASIC. And the first thing they say is directors are primarily responsible for the financial reporting process and for the judgments and so on that you make therein. Some of the other things they're telling companies to be mindful of is that information needs to be high quality and be prepared timely. So your financial reporting close process needs to be robust. Your financial position papers are required and be signed off by the directors. So where you have a judgment area in the accounts, management should be preparing robust position papers to explain how they've come to whatever judgments and conclusions they've come to, and then the board can approve those if they agree. ASIC has also said there needs to be appropriate analysis and conclusions in your financial reporting. And you've got to be making references to relevant accounting standards. So if you're using your judgment, that has to be in the context of the financial statement of the accounting standards as well. You need to have appropriate experience and expertise in your financial reporting process, so either within your team or if you're a smaller organization, then the use of appropriate experts to help your team. The reporting and audit process is crucial in terms of the reporting process and the financial reporting estimates and judgments that you're making. You have to be focusing on the difficult and complex areas. Judgments, estimates, forward-looking information, crucial in your financial reporting, and then the documentation and the disclosure thereof is absolutely critical. The operating and financial review for listed companies need to be telling the story of what's happening with the entity. And any underlying drivers in how the company's performing, where the company's at, what the company's doing, that needs to be explained properly and disclosed properly. ASIC's also said there needs to be a reasonable basis for forward-looking information. And if you're a listed company, you need to be keeping the market updated. The last thing that ASIC also said is that audit fees, and ASIC did say this, not me. As an auditor, I agree fully with this one, but audit fees should be reflecting the additional audit effort in the judgment areas in your financial reporting. So thanks for that, ASIC. I agree. Now, in terms of a little bit more information on those key areas in your financial statements, so when it comes to asset values, you've got to be looking at the impairment of non-financial assets. So you've got the mandatory testing of indefinite life, intangible assets, and goodwill. You've got to be looking at whether key assumptions and the valuation method and so on used in your impairment review is appropriate, and the disclosures around it is absolutely crucial. Valuation of property assets, absolutely crucial right now. We've seen properties go up and down, in particular commercial and retail properties. So you need to be working with a valuer that you trust, a valuer that's appropriately qualified, and so on. And when it comes to lease accounting, you've also got to consider whether there's any impairment potentially of your right of use assets. Looking at expected credit losses, you've got to be making some key assumptions when you're determining your expected credit losses, and those need to be reasonable. But also your past history of looking at your credit losses might need to be just taken in the context of 3 years ago, you might have a different set of circumstances than you have today. So you've got to be quite reasonable in terms of how your current expected credit loss model is impacted by your history. And then there's a couple of other things looking at other assets, like, for example, the net realizable value of inventory is important. Can your DTA, your deferred tax assets, be realized, and so on. In terms of provisions, ASIC has given us this list. This isn't my list, but it's a good list. They've said the kind of provisions they'll be looking at is own risk contracts, restructure provision, make good provisions, mine site restoration, and provisions for financial guarantees given. So if any of these are relevant to you, they're quite crucial areas. A lot of estimates and judgment might go into these. Give me a call if you want to talk about any of those. So around disclosures, when you've got changes from the prior year, that's an important disclosure, and you need to disclose that properly with appropriate background and discuss it properly. When there's uncertainties and changes of key assumptions and sensitivities and so on, and around your current and non-current classification, those disclosures are quite crucial. And the disclosures in your OFR are also considered important, and ASIC will always look at those straight to the OFR when they look at the accounts to just see how the company's telling the story of what's going on. And then also just make sure any non-IFRS information in your director's report is not misleading. So I've gone through the ASIC media releases in the last few months to just see what kind of things ASIC's doing in terms of the actions they're taking. They're taking a lot of actions against SMSF auditors. I'm an SMSF auditor, so that doesn't make me very happy, but there's a lot of dodgy providers out there, and ASIC's doing a lot of action on that. There's a lot of action against greenwashing. Well, a lot, is ramping up. So when I say a lot, I don't mean there's hundreds of them. There's, 2 or 3 in the last 6 months. They're taking action against financial services licensees. Now, if you hold an AFSL, that is a key focus area for ASIC. It's crucial to the market regulation of Australia. And so ASIC is always very much across AFSL licensees. And they've taken action against a few of those. A few actions have been taken against directors, and then they've banned a number of financial advisors. So anything around financial products, financial advice, AFSL, those kind of things, crucially are high on their list, and they're taking a lot of action on those. And that's it from an ASIC update. Jimmy has 1 or 2 other things that he just quickly want to run through before we go to Tom for his dazzling sustainability update.
Thank you, Renee. So the first one is continue the vein of the IFRIC story that we have told. So this is to do with the crypto asset, the Bitcoins. So we don't have accounting standard in ASB IFRS to specifically address crypto assets. So, and also we're not expecting one standard coming through anytime soon. So what we have is actually an IFRS, the IFRIC agenda decisions on this topic. So they pretty much conclude applying the current accounting standard on crypto assets. You will either reach a inventory or intangible asset conclusion. So depending on how you use the crypto assets. So all of this hasn't changed. So what has changed is in the past few months, US GAAP, they have issued their own accounting standard on the crypto asset. And they actually say, okay, this one can do fair value through profit or loss. So if you are dealing with the crypto assets and you are trying to research how do you account for it, so please be very mindful that IFRIC and the IFRS have their own rules rather than looking into the US to see how they account for it. And if you have a US subsidiaries or US related company or parent company, please be mindful of the difference in the accounting treatment. And the other things I would like to mention is we have a new consolidated entity disclosure statement. So that's basically additional things that you need to put in the director's report. So this is not applied to every single company. So what does it, who will be affected is the public company. So if your company's name doesn't have a PTY to it, so very likely this may apply to you. So for all the public company, either listed or unlisted public, you will need to include this statement in your report. So this is effective already for the first time for the coming June reporting period. So if you need to make that disclosure, you will need to say what are the entity that's being consolidated into your financial statements, what's their name, their ownership percentage, where do you incorporate it, or what's the tax residence of those things, of those entities. And if your company does not produce a set of consolidated accounts, you will just need to say that in the statement. And very interestingly, for the director to sign off this statement, they actually have to make a true and correct statement about it. That is quite different from our true and fair. And for a listed company, a CEO and CFO will need to make additional representations on those areas. That's pretty much conclude my update. I'd like to hand over to Tom to give you the update on the sustainability.
Thank you, Jimmy, for that, for those updates, and Renee. And good afternoon, everybody. I'm going to take you through sustainability updates. Now, we've only got 15 or so more minutes to get through this. There's a lot of content, a lot to get through. It is a big change for everybody. If you haven't already heard of sustainability, I think, and the concept, I think it's pretty much time now at this stage to get familiar with it and to get going. Now, most of the people on this call, you'll be producing financial reports in accordance with accounting standards. With time, you will be producing sustainability reports in accordance with sustainability standards. So if you can imagine all the work that goes in and all the process that goes into preparing financial reports, well, you're now going to be creating a process to produce a sustainability report with time. So understanding the data you need to capture, setting up systems and processes, creating systems of internal control, and so on. So if anybody's still feeling stale or bored in your job, well, you're going to have something new and exciting to learn. It's going to be a fun journey for all of us. So yeah, my advice is to embrace it. Now, in terms of an Australian context, there are two standards which have been are in draft format. They've gone through a number of consultation processes. It's currently sitting with the Parliament to pass the Treasury legislation, which will give effect to these. But I think they're getting pretty close to what they're what they look at in final format. So you've got ASRS 1, general requirements for disclosure of climate-related financial information, and ASRS number 2, which is climate related. So climate is the first cab off the rank. It's the first topic that is going to fall under the broad umbrella of sustainability reporting. And in terms of the other standard there, ASRS 101, it's called a service reference standard. So there's quite a lot of pre-existing sustainability related frameworks in place, legislation, regulations, and so on, both locally and internationally. And some of those will be referenced in the standards themselves. So that's really just a compendium or a reference standard where you can go if you need to look at those particular documents. So in terms of the core content, on the right-hand side, you'll see the content item. It talks about governance, strategy, risk management, metrics and targets. So that is the basic framework that you'll see that's outlined in FRS 1 and all the future sustainability standards. It'll talk in these, you'll need to disclose in these kind of 4 core kind of areas or components. So from a climate perspective, you know, what's your governance processes in place? What kind of structures have you set up? Have you got committees? Have you charged somebody from the board to take carriage of this? Have you taken on sustainability professionals? So on and so forth. So that talks about governance frameworks. The strategy, yes, what is the actual strategy you're going to put in place, which is going to manage climate-related risks and opportunities. Risk management process. So you've already got a risk management process around your business and financial risks. Well, now you're going to expand that. It'll include climate and with time, future sustainability-related risks. And, you know, how do you identify and mitigate those risks? And metrics and targets. So if you haven't had a chance to look at the standard yet, metrics and targets, there's actually there's quite a bit of detail in there, and it talks in terms of 3 broad categories of metrics. One is cross-sector. So it talks about such things as, well, how is, you know, how is climate linked to executive remuneration? Have you deployed capital to address these kind of risks, so on and so forth? There are sector specific times risks or metrics that you'll need to deal with, and there's also then this other category which will include metrics that are already in existing. So INGERS is a good example. There might be people on this call who are already capturing reporting under that legislation. Those targets will also be included or disclosed as part of this new regime, and there could also be other metrics and targets that you'll need to include as well. So that in itself, it's quite a large area. In terms of what those risks and opportunities are that I mentioned in the previous slide, it'll talk about risks themselves. It's divided into 2 categories. It'll talk about physical risks. So if your business is, you know, subject to flooding, if you're in a floodplain, or if you're in areas that are having, you know, higher rainfall as a result of climate change, if you're in areas prone to, you know, cyclones, hurricanes, you know, what does that mean in terms of, you know, potentially increased frequency and so on? You know, what does it mean if, you know, if you're a wine producer, or horticulturist, or agrarian of some description, and your optimum location is no longer optimum because of changes in average temperature and so on. So that all gets captured in, you know, physical kind of risks that you'll need to address. And transitional risks, that they talk to what the kind of, you know, as we transition to a low carbon economy, what does this mean for your business, and how are you going to manage those risks? What kind of regulation and policy is going to impact your business, and how are you going to deal with it? There aren't just risks, there are also opportunities. So, you know, there are savvy, you know, businesses out there who have responded to this and who've come up with new products and services and so on to cater to this new type of consumer, these new types of regulations. You know, I always use the example of alternative meats. You know, they're a response to a change in consumer demand, which is, you know, ultimately is sustainability based. So there are opportunities as well. So if you have got those, or if you have identified those opportunities, this is your opportunity to, you know, to disclose those. There are very familiar concepts in ASRS 1 around talking about materiality, around fair presentation of information, around disclosure of material information. So the concepts are very familiar, and as financial reporters or financial preparers, we're used to those. It's really just you know, reporting them in a different context. Financial modeling. So there is scenario analysis that needs to be undertaken and modeled. So that's quite a technical area, and I'll probably touch on that a little bit more when I come on to the challenges you'll face. And as a result of those financial models, you'll come up with a financial impact of these changes. So that's That's really core content. In terms of the Treasury legislation itself, there is a phasing approach. So the larger entities will be subject to this mandatory regime first. And I would have thought most of the people on this call will fall into the phase 2 and 3 category. So the thresholds are around, or the criteria is around employee revenue gross assets. So as soon as you tick 2 of those 3, that will designate what phase you fit into and when you need to start reporting. Inger's reporters are captured in, I think in phase 1, they're already reporting, but if you're a controlling entity under Inger's, then you're also going to be a phase 1. I'll talk a little about modified liability. So there is an understanding and an acknowledgement that this is new to people, it's new to everybody. The disclosures, we may not get them right first time, so there will be limitations in terms of how liable you will be under the law if you get those wrong on a user, and if a user places reliance on those disclosures. So there is a period of grace while we're all getting up to speed. The legislation is before the Parliament at the minute, so if you're keeping an eye on the news, might be reading some headlines coming out from the politicians around. I think I've read, perhaps we haven't given it enough time to think of these big changes. There could be issues around costs of compliance and so on, those increased costs, whether it's worth it or not. But I think we're getting close to what the final draft of everything is going to look like. In terms of assurance, so this is the bit that gets myself and Renee really excited as auditors. There is going to be a phased introduction and around what needs to be audited, what doesn't, and the levels of assurance that are going to be required. So if I take Group 1, so your Group 1 reporter, you're going to include climate-related disclosures in your annual report from December 25. So at December 25, any disclosures around governance and risk management processes, the auditor will have to give his opinion to make sure that they're adequate and sufficient. So that'll be reasonable assurance, an opinion on that disclosure, and limited disclosure around Scope 1 and Scope 2 emissions. In years 2 and 3, there'll be a gradual evolution to total reasonable or to complete reasonable assurance. So Scope 1 and 2 will be reasonable assurance in year 3. In year 2 and 3, then there'll be limited assurance around what your transitional plans are, those scenario analysis that will require a level of assurance. Scope 3 emissions will also be limited. And eventually, after on your 4th year of reporting, it'll be full reasonable assurance over all the disclosures in the annual report. There is quite a work being done internationally by the International Audit Standards Boards, because although the principles of audit are the same, we talk about materiality, disclosures, limited versus reasonable, applying them in a sustainability context requires a little bit more thinking through. So a classic example is reasonable versus limited. In a financial report scenario, it's quite distinct what the 2 levels of work required to achieve either level of assurance is, but in a sustainability it's not actually quite clear. So there is a lot of work going on in the background around that, and myself and Renee are keeping a close eye on that. But eventually, everything will be audited that's disclosed in your report. Now, preparing for this, I think, and I'm touching what I said on earlier, it is new for everybody. It is challenging. So there will be, you just need to educate yourself probably first up. What are these? What is mandatory climate disclosing? What is exactly we're going to be reporting on? Then you can make your plan, make your assessment, and from there you can prepare all your policies, think about what the systems you'll need to put in place are to capture the data that you need to report on. I touched on metrics and targets. Financial modeling, that's going to be, as I said, that's going to be quite a technical piece of work. And then we'll have our report, and there'll be the assurance like I touched on. And finally, challenges. So it's a new area. We're all learning. I didn't mention we produce financial reports. Now we're going to produce some sustainability reports. The work is going to expand. There's more work required, but there's not more people to do it at the moment. So it's going to fall on us and the people online to get up to speed and to do most of the legwork in terms of getting ready. It should be finance led. So a lot of the data required to make these disclosures and a lot of the data you need to capture, it is already residing within the finance team. So there'll be data on electricity invoices, fuel invoices, and so on. That data is already there. And it will ultimately form part of an annual report. So it'll be fall into under the, the auspices of the CFO and his group reporting team to make sure these disclosures are adequate, complete, and you're recording and disclosing what you need to disclose. So, if you've got, probably more sustainability type, procurement type professionals involved, they wouldn't be familiar with that process. So you might not end up with an optimum process if you rely too heavily on those professionals. Absolutely, they have a role to play, but ultimately you need to bear in mind that it's going into a report which will be audited. It'll be same kind of principles around financial reporting. It should be CFO and finance led. Again, I touched on systems, processes, and so on. Templates. Unfortunately, there are no real templates available at the moment. The nature of the disclosure required is quite qualitative in nature, which means it's going to be what you include is going to be quite tailored and specific to your entity. So there's no boilerplate reports out there. There's no point in going to your auditor and say, can I have a blank report, please? That's not how it's going to work. You have to do all the work beforehand and create and write these policies from scratch, really. I mentioned materiality. In a financial reporting context, it's quite straightforward. Everything gets translated into a dollar value. But in sustainability and climate, there could be different values. There are different metrics in there. Well, how do you come up to a kind of consistent overall materiality? There'll be judgment calls, and there will be experts you'll need to engage as part of the process. So I mentioned the modelers. That could be quite, that's going to be a specialized piece of work. And around your actual carbon measurement itself, depending on the nature of the entity, you will have, you may have a requirement to engage kind of specialists to help you around with the measurement issue. So that's pretty much it for me. Just to advise everybody, we've had a more in-depth sustainability webinar. Probably sometime in March. That's up on our website. So if you want to jump on and take a look at that to help you get started. We've got a carbon reporting session coming up on the 11th of June. So if you're wondering what scope 1, 2, 3 emissions are, how you go about starting to capture the data and account for those, well, join us for that session. And we'll give a further update later on in the year once hopefully everything is finalized from a treasury perspective and all the kind of requirements are known. So you can, we'll give you that update and you can start properly planning. So I think that's everything from me. I might just hand back to Renee to close out the session.
That's great. Thanks, Tom. We do have a couple of minutes left and we've received a few questions. So I might just run through a couple of questions while we still have a little bit of time. So one question we received was, what is the reporting impact for not-for-profit entities such as universities? Look, I believe that most universities are already doing voluntary sustainability reporting. I don't know if there's any universities that don't have a sustainability report. They might not be complying with the draft AASB standards, so they're most likely complying with older frameworks or roughly complying with older frameworks because there's currently no mandatory requirement for them to report. So it'll be up to the universities to see whether they want to change the content of their sustainability reports or where that's going in terms of getting assurance over it. But in terms of other not-for-profit entities, the current legislation applies to entities that's reporting under Chapter 2M of the Corporations Act. So if you're a not-for-profit entities under Chapter 2M, then that applies to you too. But if you're a not-for-profit entity that doesn't report under Chapter 2M but reports under the ASIC, for example, well, then it's up to that regulator to determine what their approach is going to be with regards to sustainability reporting. We don't yet know exactly what other regulating bodies in Australia will do. So there are some question marks, in particular around some not-for-profits and so on. We've had a couple more questions. Here's a question for Tom. Hi, Tom. We are a branch established in Australia. We are not required to prepare financial reports in Australia and register head office financial statements with ASIC. In this case, do we need to prepare an emissions report?
Under the legislation, if you're not already captured, like you said, Chapter 2M reporting under the Corps Act, then you wouldn't have to prepare and file for under the new legislation. But what I think what most entities, what you're going to find is, and we talk about, Scope 3, for instance, there is a requirement for entities to understand their Scope 3 emissions. And Scope 3 emissions relate to emissions upstream and downstream of the value chain. So you might be requested to provide certain climate-related information as part of that exercise. And if you are a branch that's reporting up into another jurisdiction, your parent entity or your larger entities within your group may need to request this information from you as well, or very similar information. So engage with your parent, ask them what they'll need, and be prepared if you're dealing with, you could get asked this question from a supplier or a customer. So I think it's going to be hard to avoid not producing some kind of sustainability or climate related information.
I agree, Tom. You might not have to put it in your financial statements, but you might still want to prepare it voluntarily. And look, we have just a minute or so left, but we've received $1 million question here. Does materiality apply to sustainability reporting? If so, how is it determined? Now, the answer is yes, it does apply. Tom, I don't know if you want to see if you can capture in 30 seconds how materiality would be determined for sustainability reporting.
So it's a very important topic. I think you could devote 15 minutes of the session to materiality, but the critical stage in preparing is conducting a materiality assessment. And that is understanding what the risks are, material risks to your business. It'll involve engagement with stakeholders to find out what that is, because that's going to drive everything. So yes, it is the $1 million question. Big topic, and we'll probably cover it in our next session, or session 3, coming down later on in the year. We will have a bit more clarity of exactly what's required. But yes, big question, and I hadn't probably answered that very well.
Thanks, Tom. Look, we've run out of time, everybody. So thank you so much for joining us, and thank you so much, Tom and Jimmy. It's been great to have you on this webinar with me today. We'd like to hear from you. If you have any questions, please speak to your usual SW advisor, or please send through your questions to one of the 3 of us. We're always happy to hear from you. Don't forget, we'll send you the slides after this session. We'd also really value your feedback on this session, so please complete our feedback survey, which will pop up on your screen at the end of this webinar. Our next session on financial reporting will be for the 31 December period, and will be online in November, so please sign up for that one, and we look forward to seeing you then. Thank you, everybody. Have a great afternoon.